In the previous video, I talked about the weighted average cost of capital. In the equation for the weighted average cost of capital, there was KD, KE, and KPE, the required return on debt, common equity, and preferred equity. So in this video, I will do the answer to the question on the slide 6 for chapter 11. Basically, this is a question that is asking you to calculate KD. Okay, so KD is the required return on debt. It's pretty straightforward. The required return on debt, there is an easy way to calculate it because it is given by the financial market. Okay, so KD is simply the yield on our bond. Okay. The one thing, though, that you need to remember, there's a small difference. It's not just the yield on our bond. The one thing you need to remember is that when the corporation makes interest payment, those interest payments are tax deductible. Okay, so the firm doesn't actually pay the yield on its bond. It pays the yield, but it gets a discount because the government is nice enough to not tax its, oops, that's a wrong. The government is nice enough to not tax its interest payments, right? So they're tax deductible. So basically, the firm only ends up paying the yield times 1 minus the tax rate. Okay. If you look at the textbook, as I said in the first video, there is, okay, the textbook would say 1 minus F as the denominator here, okay? And F is the flotation cost as a percentage of a new debt issue. Flotation costs are just cost of issuing new securities. So flotation costs in this case would be the flotation cost of debt. But as I said in this class, for this chapter, for chapter 11, I'm just going to assume that the flotation cost is 0. So for you, in this class, KD will just be the yield on your bond times 1 minus the corporate tax rate. Okay. Once we know that, then given this question, it should be pretty straightforward to calculate KD. Okay, we have a firm here, Orioles PL Pipeline. They have bonds selling at this price per $1,000 face value. We have the maturity of these bonds, and we have the coupon rate. With all of this information, you should be able to calculate the yield on the bond. So we will use our financial calculator. There are how many so N in your financial calculator, this is just a small reminder. I won't be doing this every time, but because this is the first video where I use the time value of money function on your financial calculator, I'll just repeat all of them, right? N, when we do annuities on our financial calculator, is the number of payments. So here we will have 7 years of annual, sorry, not 7 years, 7 years is here, 7 years of annual coupon payments, right? So I have 7 times 1. I have 7 years and I have 1 coupon payments per year. Then there is in your calculator a menu where you can input P over Y and C over Y. P over Y stands for payments per year. How many payments will you receive per year? And C over Y stands for the number of compounding periods per year. In this case, the bond is paying annual coupon, so there's 1 payments per year, and we want an effective rate. We want an interest rate that is compounded once per year, so we want C over Y to also be 1. PV is the value today. How much do we need to pay today if we get this bond? Well, we need to pay 987.92. And I need to put this in my calculator as a negative number because that's a cash outflow. If I buy this bond, I'm going to receive an annual payment of 7% of the par value. So I'm going to receive 7% times the face value. That should be $70. That's my PMT. And the FV is how much will I receive on maturity of the bonds? Well, at maturity of the bond, I will receive the face value, 1,000. Notice that this number is positive because I receive it. This number is positive because I receive it. And finally, this number here is negative because I will have to pay that number today. I can put all this information in my financial calculator. 7 is n. C over y and p over y is 1. The PV is 987.92 negative. Our payments are 70. And my FV is 1000. I make sure that P over Y, C over Y is 1. I already did it, but I had kind of forgotten. Okay, and then I can just compute the interest rate or the yield on the bond. And I get that the yield on the bond is 7.23%. Now, for exam purposes, for quiz purpose, I recommend keeping all of the decimals. Okay, I don't 100% care if you don't keep all the decimal. If you show your work, I'll give you the points anyway. But in order for the computer to give you the right answer, it's a lot easier if you store this information and keep using this information throughout the question. Okay, so if you wanted to do that, you could just use the stow key here. You can hit stow 1, and that now has saved this number under 1 in your calculator. So let's say you do some other math, right, and you have this number here, but you needed to get back this number. You could just do recall 1, okay, and then you still have the full number with all the decimals. Using this will help you do the question on the quiz and not get silly mistake because of rounding differences. Okay, so I recommend trying to use this whenever possible. It will help you again on the quiz. The exam, I will grade it myself. I'll go back over your work, so I'll be able to see if you just did a rounding mistake, and I should give you the points on the exam. But it will really help you on the quiz if you can learn to use the store and recall function. So don't forget, you want to save this number, store, let's say it's 1. You could also store it as 8 or store it at 6, right? And then if you want to get this number back, recall 6, for example, and it will come, well, let's put something else so you can actually see it. But if I do recall 6, this number comes back. Okay, so this is the yield on the bond. The answer is not complete. In order to get the actual final answer, right, so to calculate the required rate of return on the following bonds, we need to adjust for the tax rate because, again, remember, the government is nice enough to give us a tax discount when we make interest payments. So the required return, or KD, is just going to be my yield that I multiply by 1 minus my tax rate. In this case, the tax rate is 20%. So it's going to be 7.23 times 0.8. Again, I would prefer to use this number here, times 0.8, and we get the final answer. This is 5.78%. And here you go. This is how we can calculate the required return on the debt of a company. The nice thing about all this information is it is just easily available on the financial market, right? If you want to buy a bond, you can easily find its price. You can easily know its coupon. You can easily find the tax rate paid by a corporation. So all of this information is given by financial market. And that is it for the first question on how to find a required return on debt. The next video will be on how to find a required return for either common equity or preferred equity. I think it's preferred equity.